Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. We've just wrapped up a very volatile week, one of the most volatile weeks we've seen in quite a long time, much less 2014. And I want to look a little bit more closely at how this risk aversion theme is developing, because specifically we've seen a lot of headlines about emerging markets. And that misses the mark for many people. They don't make the connection, and I want to make that connection for you here today. We'll talk about emerging markets, why they're important, how it kind of transitions into the broader financial system, and how we start to eventually make better trades out of it rather than just getting into those extremely volatile emerging market exchange rates. All right. So the first thing to keep in mind is when we're trading fundamental themes or headlines like this that we put into perspective. It's easy to put into perspective when we look at our benchmarks, the S&P 500. Huge collapse into Friday, biggest drop that we have seen on a daily basis in a long time. The weekly, similar situation. For FX traders, this was a easy jump over to the yen crosses. Dollar yen, as you can see, had made a incredible break, finally breaking the floor of this wedge. But it's really the euro yen, the pound yen, those type of currencies that I think have the most fundamental pressure, the most fundamental weight to extend reversals. But those reversals only extend if the pressure that is keeping them going remains in place. Otherwise, there is a very good reason why the yen crosses were elevated. They were being backed by the considerable effort of the Bank of Japan in inducting that huge stimulus program, and expectations that they will continue to do so. The same thing with the S&P 500. While I like to poke holes in why it's so aggressively strong, it does have strength for a reason, and that's the general expectations of stability and complacency amongst the investing masses. All right, so if we want to see a continuation of this nascent bear trend, we need to have a reason to continue on. And the emerging markets is starting the push in that direction. All right? It itself cannot actually maintain the kind of pressure we're seeing in yen crosses and the S&P 500 alone. And it's especially important if we want to see an escalation whereby we are talking about not just equities dropping and potentially evolving into a full-blown bear trend. That's going to be the first hurdle. It's going to be a transition not just from the yen crosses and the most sensitive of the risk-based currency and asset markets, but also an influence on the dollar. If you want to see the dollar play its role as a safe haven, if you want to see the euro dollar return to its traditional role as a safe haven versus a relatively risky currency, you need to see that scale. All right. So starting with emerging markets. All right, emerging markets encompasses a lot of the world. It is essentially the world that has not hit the peak growth or per capita GDP of the world's largest economies like the United States, the Eurozone members, Japan, even China can to some extent be considered a developed country, but it still falls in the emerging market category. All right, these countries are exceptionally sensitive to risk around the world. Why? Because a lot of the developed world's capital goes into the emerging markets when they want a substantial rate of return. So when they're confident, when they are not concerned about risk and more concerned about the return that they're going to get on their investments, they go to emerging markets, which have high level of yield. Why? Because once that capital gets into those countries, their rate of growth jumps exponentially, and the rate of return, the yields that they pay, increases in tandem. All right? So we see that performance typically follows the positive influence of the overall world. And when we see a reversal in those circumstances, that's when things are starting to fall apart. That capital starts to pull out of those countries, and we see that once the flood starts, it really gains momentum. This is exactly what we're seeing here on the dollar Argentina peso exchange rate. All right, dark red. This currency pair has accelerated to an extreme point. All right. The past session, Friday's session, was actually not as remarkable as Thursday's. Thursday's was incredible, over 13% daily change. All right. That is extraordinary. That is highly unusual from a general perspective. Not necessarily that unusual for emerging markets because they tend to be volatile, but this is still extreme. And this is a major concern. That means that investors are trying to pull their capital out of Argentina, and while Argentina's central bank typically holds the exchange rate steady It was unable to do so through this past week. Why? Because the outflow of capital was stronger and more excessive than they were able to offset. All right, so you would have the central bank trying to sell U.S. dollars, trying to cool this exchange rate off. It was not happening. And as you can see here, massive increase in the exchange rate. Same thing with actually their local capital markets. As you're pulling capital out, obviously you're going to be pulling it out of the most liquid of the markets in the country, and the Argentine stock exchange or stock index, the Buenos Aires index, actually had a remarkable decline of its own, though not to the extent of this. All right. Why? Because a lot of the capital was being pulled out of their debt. It was being pulled out of their credit markets. So you don't really get that to be a measurement in stocks, traditional stocks. Now, it's important to realize that this isn't just Argentina. There are a number of other currencies. The Turkish lira was another one, and this one has the Turkish lira has significantly dropped. And this is another one where they are struggling to keep the exchange rate in check. The central bank is having to, as aggressively as they can, buy up their own currency and selling U.S. dollars on the market, and it's taking a considerable amount of money to keep this as stable as it is. It hasn't seen the level of volatility that the Argentine peso has, but it certainly has seen some significant volatility. The same is true with the Mexican peso, the Brazilian real, the Indian rupee, all right, and a number of other currencies. Now, I want to point out the Indian rupee. It wasn't too long ago that the Indian rupee, actually back in August, was itself the source of a crisis for the emerging market, FX world. Remember, we had a drop to record lows for the rupee as investors tried to pull their capital aggressively out of the country, and it was causing substantial problems. I have it here mapped against the emerging market volatility index, and generally emerging markets were in turmoil because of the Indian specified problems. All right, it's very communicable when we're talking about the emerging markets. When we see a problem in one emerging market country, it can easily spread to the rest of the world. This is what happened back in, or the rest of the emerging markets. That's what happened back in 1997 when we had the Asian financial crisis. All right. Now, I'm not going to try to fearmonger. I'm not going to tell you this is itself the new coming of crisis, but it certainly has the necessary ingredients to become much worse. All right. And we will watch how the emerging markets develop from here. Here's the emerging markets ETF and the volatility index. Of course, just like the S&P 500 versus the VIX, when I flip it upside down, that volatility index, that measure of fear will increase as the markets drop off. This is still relatively stable. When this broader measure of that market starts to come back down, that's when we have real problems. All right? And then when we have a transmission to the rest of the world, or the rest of the world's assets, all right, developed world and credit markets and all those other assets, that's when we have major problems. That's when we're talking about a lasting bear trend in U.S. equities. That's what we're talking about, really a lasting bear trend in global equities. That's what we're talking about the U.S. dollar and treasuries being prized as ultimate safe havens. All right, but we need that escalation. All we need to see is this to jump over to the capital markets. It wouldn't take much. We know how excessive the risk is for markets like the S&P 500, where leverage has been used to an extreme extent. All right, investors are exceptionally positioned in over-risked assets, overpriced assets, and participation has dropped off like a rock. Right, fewer people trying to hold up a market at extreme highs. That becomes very dangerous. All right, so in effect, we can actually just see these markets take over in risk aversion, and emerging markets could stabilize. That wouldn't happen, but they could stabilize, and we would have our successful transmission. All right, we're watching full-scale risk trends. If we have a stabilization, all right, if the emerging markets stabilize and these benchmarks like the S&P 500 are able to level off before they get to that crisis level, you will see that a number of the more dramatic drops in the FX world will correct. All right, dollar yen will probably be one of the better ones to see that correction because you're talking about the U.S. dollar, and the U.S. dollar is not just a safe haven so it can pull its own weight against further risks, but more importantly, as we go into the Fed's upcoming rate decision, that taper expectation can also give the dollar another reason to be bid. All right, so a short-term rebound would be best for the dollar yen. But you can also see a possible performance here in the CAD yen and Aussie yen. Both of these have a relatively high relatively high yield. The Kiwi dollar itself actually is facing the RBNZ rate decision, which is actually an hour after the Fed rate decision, so that's going to be a big one to watch, but it will be certainly heavily sourced in volatility, so you may have to be very careful with this. Now, if we do see a continuation of risk aversion, all right, and it's not just the high level, high volatility, highly sensitive yen crosses like the dollar yen and the Kiwi yen and the CAD yen that are suffering, you will see a lot of the yen crosses, of course, can be great opportunities. I will be watching for the euro yen continuing. It's just tentatively breaking this neckline on this head and shoulders pattern, and it has a lot of room it can retrace. Right? Euro yen because of its fundamentals, pound yen because of its expectations. Both of these pulling back would be good. Be careful. UK GDP next week. We have a ton of stuff next week, and I will cover it in full extent into the trading video. But these will be great options. But as we see the scope and scale of risk pick up and risk aversion really kick in, I'm going to look to more of the traditional currency pairs, like euro-dollar. I like the euro-dollar a lot. I think that it can definitely correct much further than it already has. Long term, we are in a very large wedge pattern. All right, and seeing a correction off the top of this wedge pattern would play very well into a risk aversion theme, especially with when we're talking about unwinding excessive exposure. Guess who has excessive exposure in their periphery government bond market? The Eurozone. All right, so that deleveraging can also be a major catalyst, and it starts off with this pattern here, a nice reversal potential, and it can turn into something much more prolific. But that's only if we see the upgrade in risk scales. All right, it's very important that we look for that upgrade, and it all starts in the emerging markets. All right, so keep a close eye on these emerging markets if they continue to be a problem, and if it continues to drive the developed world capital markets, then we have something very material, very trade-worthy on our hands. Good luck trading next week, guys. In the meantime, I hope you have a fantastic weekend. I'll talk to you once again on Monday.